Welcome to our guide on Indirect Roth IRA rollovers. Transferring a Roth IRA to a new custodian can sometimes be straightforward, but occasionally, complications arise. In this video, we will explain the process of an indirect rollover, its tax implications, and potential challenges. Let's briefly outline our agenda for today. We will start by introducing rollovers, then compare direct and indirect rollovers, followed by a discussion on tax implications. We will walk you through a step-by-step guide and discuss how to avoid indirect rollovers. Finally, we'll cover key considerations and wrap up with a conclusion. To understand the types of rollovers, we have direct and indirect options. A direct rollover is a seamless transfer of assets directly between financial institutions. On the other hand, an indirect rollover involves receiving funds into your bank account before moving them to your new Roth IRA. Here, you have a 60-day window to complete this transfer. Now let's discuss the tax implications of an indirect rollover. While the 60-day rule is crucial to avoid penalties, it is particularly important to keep in mind the 20% withholding. The financial institution transferring the funds typically withholds 20% to cover potential taxes. Since this amount is often refunded once you file your taxes, it's essential to have this 20% available in your savings to meet the 60-day rollover period. Failing to do so will result in a tax penalty. This ensures the full amount of the rollover is deposited into the new Roth IRA. Here's a step-by-step guide to conduct an indirect Roth IRA rollover. Step 1. Request a distribution by contacting your current IRA custodian. 2. Receive and deposit the custodian-sent check, remembering it will have 20% withholding. 3. Contribute to your new IRA, ensuring the full amount, including the withheld 20%, is deposited within 60 days. 4. Document meticulously, tracking the original distribution, deposit, and contribution. Step 5. File your taxes to get a refund of the withheld amount and report this as an indirect rollover. Now let's test your understanding with a quick quiz. What is the maximum time frame you have to complete an indirect rollover into a new Roth IRA? Is it 30 days, 45 days, 60 days, or 90 days? You may pause the video to think about your answer. We'll discuss the correct answer in the next section of the video. The correct answer is 60 days. You have up to 60 days to complete an indirect rollover to avoid taxes and penalties. While indirect rollovers are possible, opting for a direct rollover is strongly recommended. Direct rollovers minimize the risks of errors and eliminate the need to use personal funds to cover the withheld tax amount, thus simplifying the process significantly. It's crucial to consider a few key points. Firstly, understand that each institution's procedure may differ. Carefully read and comprehend your custodian's specific processes. Secondly, if you're uncertain or have additional concerns, consulting with a qualified financial advisor is advisable. In summary, indirect Roth IRA rollovers require meticulous planning and diligent attention to detail, especially concerning the 20% withholding rule. While exploring indirect rollovers, also consider direct rollovers as a simpler alternative. Lastly, reaching out to a financial advisor can provide valuable guidance. Thanks for watching our guide on indirect Roth IRA rollovers. If you found this video helpful, please like, share, and subscribe to our channel. We would love to hear your thoughts and experiences in the comments below.